every new trader has the same thought at some point. There has to be an indicator that works every time. A secret tool that shows me exactly when to buy and when to sell. You know the feeling? You're staring at your chart. You see the candles moving up and down, and you wonder, what if I just had the right tool? What if there's a simple line or signal that could tell me exactly what's about to happen next? So you go hunting. You try the relative strength index, you try moving averages, you try MACD Bollinger Bands, Fibonacci lines. Each one feels like it's almost the answer. It works on some trades, but then the next time, it fails. And that's when the frustration kicks in. Because if the tool worked once, why didn't it work the second time? You start thinking, maybe you just haven't found the right one yet. This is the trap that almost every trader falls into, chasing indicators. Meet Noah. He's a fictional trader, but his story is one that thousands of real people live out every year. Noah started with a $1,000 account and a dream. He watched a YouTube video about RSI, how when the line drops below 30, it means oversold, and price should bounce. So he tested it. One day, a stock hit 28 on the RSI. He bought. Within an hour, the price ripped higher. Noah made $200 in a single day. It felt like he had unlocked the code, but the very next week, the same setup appeared. RSI dropped to 29. He bought, and this time, the stock kept falling. It fell another 10%, then 20%. His stop hit, and he lost half his gains from the week before. Confused, Noah looked for answers. He thought, maybe RSI isn't the holy grail. Maybe MACD is he added it to his chart. A week later, the MACD lines crossed. He entered long, and again it worked, this time for a quick scalp. But then, the next crossover failed, and the one after that. This cycle kept repeating. Noah switched to moving averages, then to Bollinger Bands, then to Fibonacci retracements. Every time, he'd win a little, then lose a lot. Months later, his account was nearly drained, not because he never found an indicator, but because he believed an indicator would save him in the first place. That's the myth, that indicators can predict the future. Here's the truth. Indicators don't work the way most traders think they do. Indicators are not crystal balls. They don't see the future. They don't know what's coming next. All they do is tell you something about the past. Think about it like this. If you're driving a car, an indicator is like the rearview mirror. It tells you what's already behind you, not what's around the corner. It can give you context. It can help you stay aware. But if you try to drive using only the rearview mirror, you're going to crash. That's exactly how most traders use indicators. They stare at the lines, thinking they're predictive when really they're descriptive. This doesn't mean indicators are useless. Far from it. Used the right way, they can help give structure, context, and even confidence. But used the wrong way, chasing signals, piling 5 different tools on the same chart, believing one will tell you when to buy or sell, they destroy accounts. The market doesn't reward you for knowing the best indicator. It rewards you for managing risk. But new traders don't want to hear that. Risk management isn't exciting. Indicators are. Risk is boring. Indicators feel like magic. That's why the indicator hunt is so seductive. It feels like progress. Every time you add a new tool, you think you're getting closer to cracking the code. But in reality, you're just adding more noise, more confusion, more excuses to avoid the real work. And the real work isn't finding the right signal. The real work is learning to trade without needing one. Noah never learned that lesson, at least not until it was too late. By the time he realized no indicator was going to save him, his account was down to almost nothing. And the worst part? He didn't just lose money. He lost confidence. He convinced himself that trading was rigged, that it wasn't possible, that the market was unfair. But the truth was simpler. He had the wrong expectations. Indicators don't fail traders. Traders fail when they think indicators are supposed to do something they were never designed to do. So if indicators don't work the way most people think, then how do they work? What's the right way to use them? And why do so many traders keep falling for the same trap over and over again? That's what we're going to dig into in this video. We'll share stories of traders who chased indicators into disaster. We'll look at why these tools are misunderstood. We'll break down the psychology that makes them so addictive, and then we'll reframe how you can use them the right way, not as crystal balls, but as tools inside a bigger system. Because the market doesn't care how many indicators you've added to your chart. It doesn't care if RSI says oversold. The only thing the market cares about is supply and demand, risk and reward, discipline and survival. And until you learn that, No combination of lines and signals will save you. This is the PsyFi Trading Channel, where we dig into the hidden side of markets and the mind. If you've ever felt trapped in the cycle of chasing indicators, this one's for you. Sit back, relax, hit subscribe so you don't miss what's next, and let's dive in. When you look at the trading journey of most beginners, the story usually starts the same way. They find a video, a course, or a post that promises the best indicator for day trading. They load it up on their chart, take a few trades, and when it works, they feel like they've found gold. But when it fails, instead of questioning their risk or their process, they blame the tool. And so the hunt begins. Let's go back to Noah for a moment. After RSI failed him, he tried MACD. After MACD failed, he moved to moving averages. Then it was Bollinger Bands, then Fibonacci retracements. Each time, the cycle was the same. First trade worked, second one failed, third one blew up. He convinced himself the answer must be another indicator. And here's the painful truth. If you line up most retail traders' charts, they look like Christmas trees. 10, 12, sometimes 20 indicators piled on top of each other. One says buy, another says sell, a third says wait. By the time they're done analyzing, the setup they were staring at is gone. That's what happened to Noah. He spent so much time chasing the perfect tool that he never learned how to trade without one. And because of that, he never built discipline. Now let's look at a different fictional trader, Elena. Elena also started with indicators. She used a simple moving average and volume as her main tools. But here's the difference. She never expected them to predict the future. She treated them like context, not answers. If price was above the moving average, she leaned bullish. If it was below, she leaned bearish. Volume spikes helped her see where interest was strong, but every trade she took still had a plan. Entry, stop, risk, and target. While Noah kept switching tools, Elena kept her process steady. She journaled, she tracked results, she accepted losses, and over time, her account grew, while Noah's account slowly drained. Two traders, two different paths. One treated indicators like holy grails, the other like simple tools. And the outcome couldn't have been more different. This isn't just a retail story either. The obsession with signals has played out in big ways in the markets too. Think about the meme stock mania in 2021. Thousands of new traders rushed into AMC and GameStop, using the same overbought and oversold signals to make decisions. RSI would flash oversold, and they'd buy. MACD would cross, and they'd jump in. But in wild, trending markets, those indicators broke down. RSI stayed oversold for days. MACD crossovers whipsawed. Traders who relied on them without context got crushed. I remember seeing traders online posting screenshots. RSI says buy at 28. And hours later, the stock would drop another 15%. Those who survived were the ones who managed risk. Those who blew up were the ones who thought the signal was enough. Forex traders know this cycle too. Entire communities have been built around systems like the moving average crossover strategy. The idea is simple. When the fast line crosses the slow line, you buy or sell. And yes, it works in trending markets, but the moment the market goes sideways, which is most of the time, the system spits out false signals non-stop. Traders get chopped to pieces. That's what happened to Marcus, another fictional trader. He built his whole system around a moving average cross. For a month, it worked. He thought he'd found the code, but when summer chop hit, the signals went crazy. Buy, sell, buy, sell. His account was cut in half before he realized the system wasn't broken. It just wasn't designed to work in every condition. And this is where the deeper truth comes in. No indicator works in every condition, not one. Every single tool has a context where it helps and a context where it fails. When you treat them like magic, you ignore that truth, and the market punishes you. Now let's zoom out to a big money example. Back in 2006, Brian Hunter of Amaranth Advisors made massive bets on natural gas, using models that relied heavily on signals and correlations. At first, the indicators lined up perfectly. The trades made billions. But when the market conditions shifted, those same models stopped working. Instead of cutting, Amaranth trusted the signals. Within weeks, the fund lost over $6 billion. That's the hedge fund version of what Noah, Marcus, and countless retail traders go through every day. A signal that worked in one environment fails in another. But instead of adapting, traders double down. They put their faith in the line on the chart, and when it breaks, their account breaks with it. So let's pause here and look at the pattern. Noah kept switching indicators, always chasing, never learning. Elena stuck with simple tools and built her process around risk. Meme stock traders blindly trusted signals, got blown out in volatility. Forex traders lived and died by crossovers, only to get chopped in sideways markets. Marcus believed one tool could save him, until the market changed. Amaranth advisors used massive models, only to be undone by relying too much on signals. The theme is the same across all of them. When you treat indicators like magic, you lose. Here's the irony. Most traders don't quit indicators because they think they're bad. They quit because they think they just haven't found the right one yet. That's the cycle. That's the addiction. And here's the kicker. Even when an indicator works, it usually works for reasons traders don't understand. RSI doesn't bounce price. MACD doesn't push markets higher. VWAP doesn't force reversals. These tools don't cause moves. They just show you something about what already happened. The price and volume are what matter. The indicator is just math drawn on top. That's why pros don't stack 10 indicators on a chart. They might use one or two for context, but their decisions are based on structure, risk, and process. They know the indicator is just a tool, not the answer. But most new traders never get to that point. They quit before they learn it. They spend years hunting the magic formula, blowing up accounts, blaming the wrong thing. And that's why we're having this conversation. Because until you break out of the cycle of chasing indicators, you'll never build the consistency you're looking for. So let's dig deeper. Why do indicators fail traders so often? Why do they give so many false signals? And why do traders keep trusting them anyway? That's what we'll cover next. Let's get right to the heart of it. Why do indicators fail traders so often? Why do so many people get tricked into trusting them, only to watch their accounts bleed? The first reason is simple. Indicators are lagging. They take price and volume that has already happened and show it to you in a different way. A moving average is just the average of past prices. RSI is just a formula that compares recent gains to recent losses. MACD is a mix of moving averages. None of them look ahead. None of them know the future. They can only process what's already happened. But here's the trap. When you look back at a chart, it feels like the indicators worked. You scroll through history and you see the MACD cross right before a big move, or RSI going oversold before a bounce. It looks perfect. But that's hindsight. In real time, those signals are late. By the time the indicator confirms, much of the move has already happened. That's why traders get whipsawed. They chase after signals that look clean in the past but messy in the present. This is exactly what happened to Marcus. Marcus built his system around RSI. Every time the line dropped below 30, he bought. At first, it felt amazing. A few times, he caught bounces right off the bottom. His account grew. But then, one day, the stock dropped into oversold at 29. He bought. It dropped more, 28, 27, 26. He thought, it's even more oversold now, it has to bounce. It didn't. It kept bleeding lower. That's when Marcus realized the flaw. RSI didn't tell him when the market had to bounce. It just told him how strong the down move already was. In a trending market, RSI can stay oversold for days, even weeks. His signal was really just a description of how heavy the selling pressure was. And this is the trap. Traders confuse oversold with guaranteed bounce, or MACD cross with guaranteed trend. The indicator isn't lying, it's just being misunderstood. The second reason indicators fail is because traders ignore context. An indicator might be helpful in a trending market, but useless in a sideways one. A moving average crossover might capture big swings when price is moving in one clear direction. But when the market chops back and forth, that same system spits out false signal after false signal. Forex traders know this pain. Whole systems are built around moving average crosses. But the moment the trend pauses, the system bleeds. Buy, stop out. Sell, stop out. Back and forth until the account is gone. Marcus lived this too. After his RSI troubles, he switched to moving averages. And once again, at first, it worked. He caught a couple of nice trends. But then, the market slowed. Price drifted sideways, crossing above and below his averages over and over. He kept following the signals. Buy, sell, buy, sell. And just like that, weeks of gains were gone. The third reason indicators fail is because traders expect certainty. Most people come to the market looking for control. They want to feel like they know what will happen next. Indicators give that illusion. When a line crosses, when a number flashes, it feels like proof. It feels solid. But the truth is, the market doesn't care about your signals. It does what it does. Sometimes the indicator lines up, sometimes it doesn't. The problem isn't the tool. The problem is the expectation. Think about it like this. A thermometer tells you the temperature right now. It doesn't predict whether it will rain tomorrow. But if you treat it like a weather forecast, you'll be wrong half the time. Indicators are the same. They describe, not predict. And when you treat them as predictions, you set yourself up for pain. The fourth reason is emotions. When a signal lines up, traders feel safe. The chart tells them now is the time, and it calms their fear of uncertainty. But when the trade fails, that comfort flips into anger, confusion, and doubt. They don't blame their risk. They don't blame their lack of a plan. They blame the indicator, and then they go hunting for a new one. That cycle, comfort, failure, blame, hunt, keeps traders stuck for years. And the fifth reason is stacking. Traders think if one indicator is good, more must be better. So they add RSI, MACD, Bollinger Bands, Fibonacci, moving averages, stochastics, all at once. The problem is, indicators are built from the same price and volume. They're all showing you versions of the same thing. So when you stack 10 of them, you're not creating certainty. You're creating noise. Noah did this. His charts looked like a rainbow, lines everywhere. Some said buy, others said sell. He froze, he second-guessed, and by the time he made a decision, the setup was gone. The more indicators you add, the more confused you get. And confusion leads to hesitation, bad entries, and bad exits. So let's pull this together. Indicators fail traders when they forget that indicators lag. They ignore context. They expect certainty. They use them for emotional comfort instead of risk management. They stack too many and create analysis paralysis. The market doesn't punish you because RSI flashed or because MACD crossed. The market punishes you because you used those signals the wrong way. And here's the scary part. This isn't just a retail trader problem. Even huge funds fall for the same traps. Remember long-term capital management. They built complex models, basically supercharged indicators. And those models worked until they didn't. They treated them like crystal balls instead of tools. When the market shifted, their signals failed. And instead of cutting, they trusted the models. The fund collapsed, nearly taking the global financial system with it. Different scale, same trap. And that's the message here. Indicators don't work the way you think they do. They're not broken, they're not magic, they're just tools. And until you reframe how you use them, you'll keep repeating the same painful cycle. So, how do you actually use indicators the right way? How do you break the cycle of chasing, failing, and hunting for the next holy grail? That's what we'll cover next. At this point, it might sound like I'm saying indicators are useless, but that's not true. Indicators aren't the enemy. They just don't work the way most people think they do. The problem isn't the tool. The problem is how you use it. Think about a hammer. In the right hands, a hammer can build a house. In the wrong hands, it can smash your thumb. The hammer itself doesn't change. It's the same hammer. The difference is how it's used. Indicators are the same way, used the wrong way, as crystal balls, as shortcuts, as emotional comfort. They'll wreck you. Used the right way, they can give you structure, context, and confidence. So let's talk about how to reframe them. The first reframe is to treat indicators as context, not answers. Professionals don't look at RSI or a moving average and think, this tells me exactly what's next. They think, this tells me something about the current environment. For example, Linda Rashka, one of the most respected traders of her generation, used simple tools like moving averages and volume, but she never treated them as signals to blindly follow. She used them as context, to see whether price was trending or chopping, strong or weak. The decision to enter or exit still came from her setup and her risk plan, not the line on the chart. That's the difference. Indicators don't tell you what to do. They help you understand what's happening. The second reframe is to limit how many you use. You don't need 10 indicators on your chart. You don't even need 5. Most pros use 1 or 2 at most. Why? Because too many tools create noise. They start to contradict each other. One says buy, another says sell, a third says wait. Suddenly you're frozen, second-guessing every click. Elena, remember her? She kept it simple. A moving average to see the trend, volume to see interest. That was it. And because her chart wasn't cluttered, her brain wasn't cluttered either. She could focus on what mattered, her process, her risk, her rules. Noah, on the other hand, kept adding indicators until his chart looked like a coloring book. And because of that, he never trusted himself. He trusted the lines. And when the lines failed, he fell apart. The third reframe is to tie every indicator back to risk. An indicator without a risk plan is just noise. Let's say RSI goes oversold. Okay, great. What's your entry? Where's your stop? What's your target? How much are you risking compared to what you're aiming to make? If you can't answer those questions, the signal means nothing. This is where most traders go wrong. They see the line cross, they enter, but they don't have a plan. They're trading hope, not discipline, and that's why they lose. The fourth reframe is to test your tools, and don't just trust that an indicator works because someone online said it does. Journal it, track it, use it on paper for 100 trades. See how it performs in trending markets versus sideways markets. See how it works with your style. Sophia, a fictional trader, learned this lesson the hard way. She joined a chat room that swore by Bollinger Bands. Every breakout outside the band was supposed to mean continuation. She bought into the hype and followed every alert. Within a month, her account was cut in half. Finally, she forced herself to test it. She tracked 50 trades where Bollinger Bands flashed a signal. And what did she find? Half of them worked in strong markets. Almost none of them worked in choppy ones. Once she saw the data, she stopped using it as a one-size-fits-all signal. She started using it as context instead, and her results improved. The fifth reframe is to use indicators to track yourself, not just price. Most traders never think of this. But indicators can be built from your own habits. For example, track how often you break your stop rule. Track how often you enter too early or too late. Turn those stats into your own signals. If your data shows you chase entries 70% of the time, that's an indicator of your behavior, and it's more valuable than RSI ever will be. Pros understand this. They know the edge isn't in the tool, it's in how they manage themselves. The sixth reframe is to embrace simplicity. Markets are already complex. You don't need to make them harder with 10 different signals. Simplicity brings clarity. Clarity brings discipline. Discipline brings survival. Daniel, another fictional trader, finally learned this after years of frustration. His charts were packed with indicators. He'd wait for all of them to line up before he entered. And by the time they did, the move was over. One day, fed up, he deleted everything. He left only price, volume, and a single moving average. For the first time, he could actually see the market. He started journaling. He started planning his trades instead of reacting. And within months, he saw progress for the first time in years. Not because of the indicator, but because he stopped drowning in them. The final reframe is to remember this truth. Indicators don't cause price moves. They don't push markets higher or lower. They just measure what's already happening. Price and volume are the real drivers. Supply and demand, fear and greed, big money and small money, those forces move the market. The indicator just paints a picture of it. And when you understand that, you stop expecting miracles. You stop treating your chart like a magic 8-ball. You start treating it like a map. Useful for orientation, but useless if you don't know how to drive the car. So here's the takeaway. Use one or two tools for context, not for answers. Keep your charts simple and clean. Tie every signal back to a real plan. Entry, stop, risk, target. Journal and test your tools. Don't just trust them. Use indicators to learn about yourself, not just the market. And never forget that price itself is the main signal. If you do these things, indicators stop being traps and start being helpful. They become a support system, not a crutch. And that's what separates the traders who survive from the ones who keep chasing holy grails. Survivors use tools to support their discipline. Chasers use tools to avoid doing the real work. The choice is yours. By now, the message should be crystal clear. Indicators don't work the way you think they do. They're not magic. They're not predictive. They're not the hidden key that unlocks endless profits. They're just tools. Tools that describe, tools that give context, tools that can help, but only if you understand their limits. The truth is, the edge was never in the lines on your chart. The edge is in you. It's in how you manage risk, how you handle emotions, how you stick to your plan when the pressure is high. Think about the greats. George Soros didn't build one of the greatest fortunes in trading history by waiting for RSI to go oversold. Stanley Druckenmiller didn't ride massive macro trends by stacking 10 indicators on his screen. Linda Raschke didn't carve out a decades-long career by blindly following MACD crossovers. They all had simple tools. Sometimes they used moving averages, sometimes VWAP, sometimes nothing at all. But what they all shared was discipline, a system, a way to manage risk first and trade second. And that's the piece most traders never get. They think the secret is in the chart, but the secret is in the process. When you zoom out, you realize that chasing indicators is really just chasing certainty. It's human nature. People hate uncertainty. They want to feel safe. They want a rule that tells them exactly what's going to happen next. Indicators give that illusion. But the market doesn't reward illusions. It rewards discipline. The reason 90% of traders fail isn't because they picked the wrong indicator. It's because they believed indicators would protect them from doing the hard work. They thought the answer was on the screen when the answer was in their habits. Noah never learned that. He kept piling indicators on his chart, thinking the next one would save him. His account bled slowly until it was gone. Elena learned it early. She kept her tools simple, tied everything back to risk, and built habits that survived. Years later, she's still in the game. Sophia discovered it the hard way when she followed chatroom signals into disaster. Only when she tested and tracked for herself did she finally see progress. Daniel figured it out when he wiped his charts clean and started fresh. Marcus never figured it out. He blew up chasing signals that he thought would never fail. These stories aren't just characters. They're patterns. They're lessons. They're the same mistakes traders have been making for decades, and the same mistakes new traders will keep making for decades more, unless you choose differently. Here's the bigger picture. Trading is not about prediction. It's about probability. It's about taking setups that make sense in the long run, not chasing signals that feel good in the short run. Trading is not about indicators. It's about risk. It's about defining how much you're willing to lose before you even think about how much you might win. Trading is not about certainty. It's about survival, because only the traders who survive long enough get to see compounding work in their favor. And survival doesn't come from stacking tools on a chart. It comes from keeping your account alive when the market doesn't cooperate. So the next time you're tempted to add another indicator, pause. Ask yourself, am I looking for certainty or am I building discipline? The next time you feel the urge to chase a signal, pause. Ask yourself, do I have a plan or am I just hoping the line will save me? And the next time you find yourself lost in analysis paralysis, 10 signals flashing 10 different things, pause. Ask yourself, do I really need this noise? Or do I need to simplify and focus on what matters? Because what matters is not the signal. What matters is how you respond. Every professional knows this. That's why their charts look simple. That's why their rules look boring. That's why their results look consistent. Consistency isn't built on magic tools. It's built on boring discipline. Day after day, trade after trade, following the plan no matter how you feel. The irony is that this boring path is what gives you the excitement you're really chasing, because when you finally build consistency, when you finally stop blowing up, when you finally see your account grow month after month, that's when trading becomes fun. That's when it becomes freeing. That's when it becomes more than just a hobby. But you'll never get there if you keep chasing indicators. So here's the challenge. Strip your chart down. Pick 1 or 2 simple tools. Nothing fancy. Commit to them for 6 months. Journal every trade. Track every result. Focus on risk. Focus on discipline. Focus on process. And watch what happens. You'll stop feeling whipsawed by signals. You'll stop second-guessing yourself every time a line crosses. You'll stop chasing certainty where it doesn't exist. Instead, you'll start building something real. A process, a system, a way of trading that survives the noise instead of being destroyed by it. And that's when you'll finally understand the truth. Indicators don't fail traders. Traders fail when they think indicators are the answer. Indicators don't work the way you think they do. They never did. But when you use them the right way, as simple context inside a bigger process, they don't need to. Because the edge isn't in the lines on your chart. The edge is in you. This is the PsyFi trading channel, where we break down the hidden side of markets and the mind. If this message hit home, subscribe so you don't miss the next one. Because the sooner you stop chasing indicators and start building discipline, the sooner you give yourself a real chance to win.